Welcome back, investors. Thanks for joining in. Today we'll be looking at Altria Group, a stock that has been underperforming the market for some time now. This dividend king has been in a downtrend since 2017, when it put in its all-time high of $77 a share. Today, the stock is trading at $41 a share and yielding almost 9.5%, making it an attractive investment for investors seeking income. The safety of this yield, however, is something that investors have been questioning, with concerns that the current yield might not be sustainable going forward. With many investments that didn't work out very well, such as Juul and Kronos Group, Altria finds itself at a point where they have to find a successful growth driver for the future. If we look at their latest 10Q, smokable products still make up around 90% of their revenues, which for a company with many ambitions for the futures, we would like to slowly see pivot over. If we head over to QuantView, our stock insight tool, we can see that revenue for Altria has been flat for some time now, almost 10 years to be exact. The EBITDA has gone up and gone down again in many phases, but the free cash flow is overall in somewhat of an uptrend. We can see that the net income and earnings per share follow the same path that we can see with EBITDA as well. Their cash and liabilities are not looking the greatest. They have, compared to their long-term debt, a very small cash pile, and the long-term debt more than doubled in 2019, following the failed investments that we spoke about earlier. Their shareholder returns have been phenomenal though, with Altria increasing their dividends for 54 consecutive years, making them a dividend king. And they've also been buying back quite a bit of shares. We'll be performing our valuation in this video in 3 steps. First, it's a margin of safety. In this segment, we'll be assessing Altria's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. In the second step, we'll be performing various valuation models to see what the intrinsic value is of the company based on different metrics. And lastly, we'll combine the 2 steps to give us a fair value of the company. To determine this final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 30%, that can never go below 0%. The margin of safety will be based on a bunch of different metrics that we'll look at in just a moment. And the severity that we'll adjust our margin of safety by is determined by using a scale. We are using 4 colors in our scale. Bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from a margin of safety. When we are using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are focused on growth. We'll be looking at the earnings per share growth and the free cash flow per share growth of Altria. And we can see that both are in somewhat of an upwards trajectory. This is mainly because Altria has been buying back a lot of stock in recent years. This caused our EPS to go from $2.54 in 2014 to almost $4 in 2023. This is an average growth rate of just over 10%, which is in the light green part of a scale, indicating a 5% deduction from a margin of safety. The free cash flow per share is looking even better. It has gone from $2.28 a share in 2014 to over $6 in 2023. This is an average growth rate of just over 15.5%, which is once again in the light green part of our scale, indicating yet another 5% deduction from a margin of safety. The second metrics that we'll be looking at are focused on financial health. Here we'll be looking at the debt to EBITDA ratio and the Altman Z-score. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And in this case, it's just under 2 years, in this case a 186% debt to EBITDA ratio, which is under the 300% that we would like to see. And 300% in this case would mean 3 years of EBITDA. This is looking pretty solid, but it's not quite there yet for a margin of safety reduction, so no change in the margin of safety on this metric. Next we have the Altman Z-score, and the Altman Z-score is a score used to predict how likely a company is to going bankrupt. It focuses on a lot of metrics such as working capital, total assets, EBIT, market capitalization, total liabilities, and much more. With this metric, it's the higher the better, and anything above 3 is considered a very low chance of a company going bankrupt. Seeing as Altria has scored a 3.7, it is very unlikely that Altria is going to go bankrupt, which awards them with a 5% deduction in a margin of safety. Next we have the shareholder return metrics, which we already saw in our stock insight tool that this has been a very strong point for Altria. Here we'll look at the dividend growth and the share buybacks or dilution if that's the case. We could see that the dividend growth rate has been pretty solid for Altria. They've grown their dividends from $2 a share in 2014 to almost $4 a share in 2023. This is an average growth rate of 8%, which is in the light green part of a scale, indicating a 5% deduction from a margin of safety. In case of share buybacks, they have done quite a bit. They've managed to reduce their share count by more than 10% in the past 10 years. This is well in the bright green part of a scale, which is once again a 5% deduction from a margin of safety. Very nice. And lastly, we have the capital allocation metrics, where we look on the return on equity and the return on invested capital. As we can see, the return on equity is calculated with the net profit divided by the equity. Since the equity in recent years has become negative for Altria, this is actually a metric that is now in the negative as well. So this makes it fall in the red category, adding 5% to a margin of safety on this metric. The return on invested capital, though, is looking very solid. To determine this metric, we have to use the EBIT, the tax rate, and the invested capital. And this gives us an idea how effective the management is at allocating capital. And they currently have a return on invested capital of 24%, which is very solid. It's almost up there with some tech companies that have very high reinvestment rates as well. This awards them with yet another 5% deduction from a margin of safety. Looking very good so far for Altria, but let's look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. We can see that Altria has been able to grow their free cash flow at a pretty decent rate over the past years, going from $5.6 billion in 2015 to over $12 billion in 2023. This is an average growth rate of over 14.5%. In this valuation model, we have determined three cases: a normal case, a best case scenario, and a worst case scenario. In the normal case, I expect the free cash flow growth to be actually negative, with a minus 5% short-term growth and a minus 3% long-term growth. I will be using a weighted average cost of capital of 9% and a perpetual growth rate of 3% in all of these cases. The best case scenario expect a short-term growth of 2% and long-term growth of 0%. And in the worst case scenario, we have a minus 8% short-term growth and a minus 5% long-term growth. And this leaves their sum of free cash flows at $131 million. And then, if we want to calculate our equity value, we have to, of course, add the cash and equivalents and subtract the debt. And this gives us an equity value of $108 million. And dividing this by the amount of shares outstanding, we get an intrinsic value of $61 out of this model, which is a 48% upside. If we then head over to the next model, this is the discounted dividend model, where we look at the past dividends and what we expect in the future to be their dividend payments. We can see that on average their growth rate in their dividends has been sitting at 7.6%. And I'm projecting a short-term growth rate in the dividends of 2% and a long-term growth rate of 2% in their dividends as well. This leaves us with an intrinsic value out of this model of $68, which is more than 65% higher than the current price. The third model that we'll be using is Graham's valuation formula, where we look at the earnings per share of Altria, the long-term growth rate expected by analysts, and the AAA corporate bond yield, in relation to the average bond yield sitting at 4.4. And we go by the theory of Benjamin Graham that the PE ratio of a company that is not growing at all should be sitting at 8.5. And looking at all of these metrics, we get an intrinsic value out of this model of $38, which is almost 8% lower than the current price. Next model we'll be looking at is the multiple valuation. In the multiple valuation, we look at similar companies to Altria Group and look at their earnings per share and their stock price, determining an average PE multiple in the industry, which in this case is sitting at 9.13. All that's left to do then is to multiply the average PE ratio by the earnings per share that Altria is generating, which is $4.57 a share. And this gives us an intrinsic value of $42, which is actually very close to the current price it's currently trading at, with only an upside of 1% out of this valuation. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. We've imported the dividend yield of the past 5 years. On an average, it has been sitting at just over 8%, while the current yield is sitting much higher at almost 9.5%. This means it's undervalued on this metric. Doing the same with the PE ratio, on average it has been sitting at just over 12, while currently it is sitting around 9. This means it's undervalued on this metric as well. And this gives us a deviation from the mean of 20%, which gives us an intrinsic value of $50, which is the same upside percentage that we got in the mean deviation. Now that we've done all of the valuation models, let's go look at the final overview of our valuation. Looking at our final overview, we've imported discounted cash flow, discounted dividend, grains valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $52. Margin of safety we've determined earlier, using our standard 30% margin of safety, and deducting it by 5% for the EPS growth, free cash flow per share growth, Altman Z-score, the dividend growth, the share buybacks or dilution, and the return on invested capital. And we added 5% to our margin of safety for the return on equity. And this leaves us with a 5% margin of safety. Applying this margin of safety, we get an intrinsic value of $49. And with the current price of $41, this leaves us with an upside of 19%, indicating that per our valuation, the stock is undervalued. What you have to keep in mind though is that this stock is not for everyone. There is a lot of uncertainty for the future, but if you're currently looking for stocks that pay you a good dividend and that you can generate nice income from, this stock is probably something for you. But if you're like me and you're still very young and you're looking for a stock that's more growth oriented, you might want to stay away from this company. So it really varies per investor. If you want to get access to all of the valuation models that we used in this video and all of our other videos, you can check in the description for our Patreon link. And if there's any other companies that you would like to see me cover on these videos, let me know in the comments as well. Thank you for watching.